I'll switch off the video. People, so I have selected two questions on long-term financing. Yes, guys, now you know companies have different ways of raising funds. Yes. When you talk about long-term financing, you're looking at mainly equity and debt. No. Yes. When it comes to equities, guys, you have what? Ordinary shares, right? You have even preference shares, right? Even though we categorize them, as a debt instrument. And then you have, yes, retained earnings, very good, Ilma. And then don't forget you have rights issues, right? Rights issues. A rights issue is when you issue shares to your existing shareholders. Yes, you know that a company who's already there in the stock market, they can issue more shares, right? That's called a secondary issue, right? They're public issues. You issue shares to the entire market. Rights issues are different because in a rights issue, you issue shares only to your existing shareholders, right? Why only to existing shareholders? So that your ownership is not diluted. Yes, right. So I want to look at two questions today, people, right? So I've selected somewhat recent, questions from your exam kit. This is ZMO, right? Okay, please look at the requirement. Actually, this has so many narrative parts. So many narrative parts compared to the calculation part. Look at this, guys. Yeah, you have three requirements. Only 6 marks are given for this, calculation. There's only one calculation and the others are all narratives. So Ilma, guys, it's not just Ilma. I'm sure all of you are facing this problem. Focus on theory. Yeah, financial management, even though you're looking at, 90% of the syllabus being calculations, you can't forget that there is, a hell of a lot of narratives. Okay, don't forget that. So I think this is really good in that way. We are going to talk about a lot of narrative parts today with this question. Okay, part A, using CAPM, calculate ZMO company's current cost of equity and a project specific cost of equity. Oh, people, you know the discounting factor that is used in project appraisal. Yes, discounting factor is your WACC, right? So sometimes when you undertake certain projects, your WACC is going to change. What's the main reason? Well, if you undertake a project that has different risks compared to your existing, business risk, then what? Your WACC is going to change. For example, guys, you imagine you're operating in, let's say, FMCG, fast moving consumer goods industry. You're operating in that, right? You are looking at a project that's there, let's say, in the steel market, right? Or automobile market. Let's say you're planning to have a new, I don't know, business venture, and that business venture is going to deal with automobile. So you're operating in the FMCG industry, but you're going to start a project in what? In the automobile market. So there is a significant change in your risks. Yes. When your risks change, your WACC is going to change. I hope you understand that. WACC is directly related to the risks. WACC is directly related to your risks. When risks change, WACC is going to change. Right. People, in cost of equity calculations, I hope that you have looked at de-gearing, re-gearing, right? I hope those terms ring a bell in your mind. De-gearing, re-gearing. So that's what I want to look at with this question. Right. People, let's not worry about the other parts. Please go through the question one more time. Using CAPM, calculate current cost of equity. That can't be, the first part can't be that difficult. And then they want you to calculate a project specific cost of equity as well. Can we calculate the current cost of equity using CAPM? Very simple, yes. People, can you go through the question, please? Please go through the question, right? Okay, I'll give you time. You need to be able to read very, very fast. You have to read very fast. Okay. Will you upload the videos of this class? Um, that actually depends. Mr. Arshad, are you a student at PPIM? Depends, yeah. You will not have access to full time. Okay, yes. If you are, yes, you will definitely have access to the videos. I am not going to upload the videos. The admin team does that. Yes, if you are a student at PPIN, you will have access to all the videos, right? Please go through the first part of the question. Hope you have read the first part. Right. People, hope you have hope you have highlighted or noted down the key information. Now start calculating. Start calculating. Get me the current cost of equity. Get me the current cost of equity. Okay, Ilma has found the answer. Brilliant, Ilma. 17.8. Okay. Now I'm going to walk you through the question before you start doing the other calculation, right? Okay. People, you're looking at a company that is operating in what? Operating in house construction industry. So basically, the construction. Past 5 years, disappointing. Share price fallen from 3.5 to 1.05. So your decline in the last 5 years, right? Uh, well, your performance in the last 5 years disappointing, and share price is reflecting that, right? The deterioration has been accompanied by an increase in financial gearing. Oh, people. So the company is undertaking a lot of debt, right? So they must be paying a lot of interest payments. Get that into your head. Okay, companies gearing is high, so they must be paying a lot of interest payments. Yeah, okay. Equity, long-term liabilities. Please look at this, guys. Yeah, wow, long-term liabilities. Look at this. 6.5 irredeemable loan notes, 250 million, and there is a 7% bank loan as well, 20 million. Right. People, loan notes are quoted at 65 per loan note. What is this? This is the price of a loan note today, right? 65 is the price quoted, right? Both loan notes and bank loan secured. People, when you go for a loan, yeah, let's say you're getting a auto loan to buy a vehicle. So when you get the loan, the bank is going to ask you to put down a collateral, right? Or the bank is going to ask you to keep a collateral, right? The collateral is usually the vehicle in an auto loan. Let's say you're going for a housing loan, the collateral is the land or the house. If you don't make interest payments, principal repayments on time, then they are going to acquire the land or the vehicle. So what I just explained was a secured loan. The loan is backed up by some asset. both your loan notes and the bank loan are secured, meaning they have assets backing these loans up. Are we clear? Usually, guys, secured loans, their interest rates, secured loans interest rates are less than unsecured loans interest. Yep, there you go. If it's an unsecured loan, your interest rate is high. Why? Because your loan is not backed up by any asset. So it's risky, right? Why is this higher? High risky, high risk. Are we clear? Right. Equity beta, equity beta, current equity beta, guys, you're looking at 2.3. Okay. So current equity beta is given, right? So they ask me to calculate current cost of equity. Easy, easy. I don't need to read this, right? So I need to look for risk-free rate and whatnot, and I can clearly see that risk-free rate is 4, expected return on the market portfolio 10%. Ah, there you go. That's enough for you to get the answer for the first part of part A, right? So now you can say current cost of equity, A, current cost of equity. Yep. Risk-free rate is 0.04 plus current equity beta. Equity beta is 2.3. Equity beta is 2.3. Expected return on the market, that was 10%, right? 0.1 minus 0.04. Guys, I usually advise all my students to convert all percentages to decimals, right? You get the final answer that you can convert to a percentage. So, Ilma, this is 0.178. Is this 0.178? So that is 17.8. Yes, 17.8%. Right. Good, good. Simple. Right. Okay. Answer to the first part of the question done. Okay. Brilliant. People, the second part, a project specific cost of equity. People, what's happening here? What's happening here? Let's see. To improve performance, company is considering construction of commercial properties. Okay, okay. Such as office blocks, industrial complexes. This is a new activity, and it is expected that risks involved will be different. There you go, people. You are operating in the house construction industry, right? Your performance have been not that great. So the company is thinking of what? Construction of commercial properties. That's a new industry, new activity. So your risks are different from current activity. People, what's happening? You're getting exposed to new business risk, right? So I'm going to put an arrow and say new business risks. New business risks. There you go. New business risks due to what? Due to new project or new activity, whatever. Financial director has proposed a project specific discounting rate. So FD is recommending a project specific discount rate, right? Commercial director, there's another fellow. Commercial director does not believe this is necessary. Whoa, whoa. Finance director knows his, finance. He knows that if the risks are different, then the return is going to be different. Return is cost. Yes, if the risks are different, then the cost of capital is going to be, sorry, if the risks are different, yes, the cost of capital has to be different. Finance director knows that, but commercial director, no, he does not believe that this adjustment is necessary. Okay, people, Winston, they're talking about some other company. What is that? Winston Commercial Properties undertakes commercial construction projects. Okay. So there is another company, WCP, they are into commercial construction. Oh, WCP has equity beta 1.25. Okay. There you go. That's very important. People, they're talking about WCP. This is a proxy company, right? A company who's into this commercial construction projects, right? Beta equity of that company is 1.25. Okay. Okay. WCP has 100 million ordinary shares currently quoted at 2.6. Company also has 110 million loan notes currently quoted at 96, and nominal value is 100. There you go. People, you need to understand your risks are going to be different when you undertake this project. Yes, you can't use the current cost of equity to appraise the new project. Why is that? Because this reflects your risks of the existing industry, house construction industry. You're getting into a new, you're starting a new project that is in a different industry. So you have different risks. Now you have to find that risk. How do you find risk in FM, guys? You usually find risk through beta. Beta is a measure of sensitivity. No? Yes, people, beta equity. I'm sure that you know beta equity talks about two different things. Can someone tell me what they are? Beta equity talks about two different things. What are they? What are they? Very good. Yes. Yes. Brilliant, Dilma. Thank you. So the two different risks are, sorry guys, wait. Beta equity reflects both business risk and financial risk. Right? Business risk and financial risk. Guys, financial risk is easy to understand. Financial risk is basically the risk that is arisen due to your gearing, right? So I'm going to say risk that is arisen due to gearing level. Gearing level is basically debt to equity, right? That's your gearing, debt to equity. Okay. What is business risk? Business risks are your normal operating risks, right? Normal operating risks. There you go. So I'm going to say operating risks. Or you can say operational risks. Whatever. Right. People, now we are given beta equity of WCP. WCP operates in the commercial property industry, right? The beta of this company is 1.25. This beta is not just a beta, it's equity beta. This beta has two things, business risk and financial risk. Yes, business risk is what we want to understand, not financial risk. Why is that, guys? the company, your company, Zmo, is going to get into commercial property industry, right? So this section is what you need to understand. Business risk of, can I say, construction, commercial property. So you need to understand the risks of what? Commercial property industry, right? I think we have to move this. Right. There you go. Yep. Okay. So how do I isolate business risk from this 1.25? How do I do that, Ilma? Now 1.25 has both business risk and financial risk. I need to dissect this, right? I need to remove financial risk from beta equity. How do I do that? Very good. Using asset beta formula. Very good, guys. So using asset beta formula, right? You de-gear your equity beta, right? You de-gear your equity beta. So what is your asset beta equation? This is given in the exam in the formula sheet, no big deal. MVE plus MVD into 1 minus T. Don't forget we have 1 minus T, right? This whole thing into what? Into beta equity. This is the asset beta equation. Are we clear? This is the asset beta equation. People, you have another component. Can you remember what that component is, Ilma? What is that other component? You have, yes, debt. Very good, debt. Ashfa, are we clear? Amurti, are we okay? And you have beta debt as well. People, we know unless otherwise stated, beta debt is always zero. Beta debt is always zero. Unless otherwise stated, BD. This is always zero. Always zero unless otherwise stated. Unless otherwise stated. Right. So if this is zero, guys, this whole thing becomes zero. Yeah. Okay. So you can forget this. This is what you need to focus on. Guys, now you start plugging in the values, right? You start plugging in the values. We know beta equity of the proxy company, 1.25. Do we know the market value of equity? Do we know the market value of equity? Can someone get me the market value of equity? You need to read this paragraph, the second paragraph. Give me the market value of equity. Hurry up. Okay, okay. Market value of equity, yes. What is the market value of equity? 84 million, okay. Let's see whether that's the value. Let's see, market value of equity. Okay, Ilma, I'll give you more time. Okay. You know what, guys? Can you get me market value of debt and equity both? 2 minutes. Okay. Ilma says market value of equity is 100 million. Okay, okay. Ilma, Please look again. Read the question, read the paragraph very carefully. Equity 260, debt 105.6. What about the rest? Amra, Amurti, Ashfa, how's it going? Hemant, Kumar, how's it going? Market value of equity 260 million. Yeah, that's very simple, guys. Yeah. They tell you 100 million ordinary shares currently quoted at 2.6, right? People, this $100 million is based on the nominal value. Are we clear? So number of shares are 100 million. So 100 million into 2.6. Are we clear? Market value of equity, guys, it's 100 million into 2.6. That's 260. Market value of debt. Market value of debt. People, when you read the question, I want you to focus on the quoted value. Yeah, quoted value is the selling price of the instrument. People, they tell you you have 110 million loan notes. People, loan notes are basically bonds. Please understand that. Loan notes are bonds. Yes, publicly traded. 110 million currently quoted at how much? 96. That's the selling price. Your nominal value is $100. People, you have issued 110 million worth of debt, right? You have issued 110 million worth of debt, right? The nominal value is 100. By dividing 110 million by 100, you get what? You get the debt quantity. You get the debt quantity that the company has issued. 110 million is the total amount. Yes, one loan note is $100. So this gives you the value, the quantity of debt. I hope you understand that. This is the quantity. By dividing 110 by 100, you get the quantity of debt. And then what? You multiply this by the current market value. Current market value, that is 96 now. 96. So 110 divided by hold on, guys. How much is it? 110 million. 110 million loan notes. 110 10 divided by that into 96. Yes, into 96. How much is that? This is 105.6, no? 105.6. Right, yeah. 5.6. Done. Okay. Now plug in the values to the beta equation and get me asset beta. Get me asset beta. Get me asset beta. 0.94. Very good. Very good. Very good. So beta assets. I'll take Ilma's answer as it is. Not going to do the working. 0.94. There you go, beta. People, what does this reflect? What does this reflect? People, this is the business risk of this company. What is the business risk? Business risk is basically the risk relating to commercial construction. So I'm going to say this reflects. Now don't write all this. This reflects the business risk. Business risk related to what? Commercial property industry. People, this is the risk that is free of financial risk. No financial risk. So because there is no financial risk, We call this, we there is another term for set beta. What is that? Because it's free of financial risk. What is that other term? Ilma, what's the other term? There's another term for this beta assets. What is it? Guys, this is your ungeared beta. Ungeared beta. Because it's free of financial risk, right? AKA also known as ungeared beta. Ungeared. Yes, ungeared. It doesn't have the financial risk in it, no. Ungeared. Okay. Just keep this in mind. Ungeared. Are we clear? Okay. So I have found the business risk of this industry. Now what do I need to do? Now what do I need to do? Can I plug this into my CAPM and get the answer? No, I can't. I can't do that. I can't do that. What do I need to do now? Very good. Yes, Ilma, we have to get the beta equity. We have to get beta equity. Yes, very good. Beta equity. How do I get beta equity? How do I get beta equity? How do I get beta equity? What do I need to do now? Guys, now I have to incorporate my company's financial risk. Yes, I have to use equation yes, without company values. Yes. In order for me to get beta equity, I have to now consider my equity and my debt values. Are we clear, people? Are we clear? Yes. Guys, the removal of financial risk from your equity beta is called de-gearing. So what we just did was we de-geared our equity beta. De-gearing. Now what do? I re-gear the asset beta. Re-gearing asset beta. These are fancy terms, guys. As long as you understand, the meaning behind this. De-gearing equity beta, right? By de-gearing equity beta, we find beta assets, right? This is ungeared. Only business risk is reflected. Now what do? I re-gear the set beta. How do I re-gear? Using my debt and equity values. Re-gearing asset beta. Again, I have to use the same damn equation, people. The same equation only. Yes. Right. So what I need to find is beta E. Now, market value of E, market value of D has to be my company's values. Can someone get me the market value of equity of my company, of Zedmo? Yes. What is the market value of equity of my company? Market value of equity. Market value of equity, 84 million. 84 million, okay. Value of debt, people, don't forget there are two debt instruments here. Two debt instruments. There are two debt instruments. What is the market value of my irredeemable loan notes? Can we get the market value of irredeemable loan notes? Hello, Mr. Kaif. Just joined the class. He started at around 7. Wanted to start the class at 6, but there was a small power cut. So this is the question that we are looking at. Not a big deal, right? This says project specific risk. That's what that is the reason why I wanted to look at this. Yeah. Right. No, that's okay, Kaif. That's okay. Please go through the question again. You can get the recording as well. You can just look at the question on your own. No need to go through the bloody recording. You can figure it out, right? Okay. People, market value of equity of Zedmo. Guys, they tell you that they have 40 million point 5 nominal value shares. So you need to get the number of shares. 40 million divided by 0.5, no? Right. So I'm going to say market value of equity, right? 40 million divided by 0.5. This is going to give me my number of shares, right? This into the market value 1.06 something, 1.05. This is the market value of equity. One shot, you can get the answer, right? So that is 80 into 1.05, 84. People, market value of debt. Don't forget there are two debt instruments here, two debt instruments. So I'm going to say bank loan. Bank loan, people, it's a private debt. Bank loans are not traded in the market. So whatever the loan value is the market value, 20, right? That's 20. Bank loan, 20. Now, irredeemable loan notes. Can I say irredeemable, bond something? Right? No need to write the whole freaking word. Bond, right? Irredeemable loan notes, anything, people, right? Okay. So just like before, guys, I think we have to do a small working. Can someone get me the market value of this debt? 65? Wow, Ilma, that was fast. Okay. Market value, Ilma? Market value. No, no, no. That's the market price, no? Market price. I want you to get the market value of the entire debt. Market value of the entire debt. Just like before, people, they have issued how much? 250 million worth of debt, right? One loan note is $100. So you can get the debt quantity, no? You can get the debt quantity, right? So 250 million, 250 million, you divide that by what? 100. $100, yes. This is also dollars. So this gives you your debt quantity. This into, what's the market price? Market price is 65, right? So how much is this? 250, that's 2.5 into 65, no? 2.5 into 65. 162.5 is the market value of my irredeemable debt. People, are we clear? Right. Now, what's the total debt? Can we say total debt? Total debt at these two. 160, there you go. Total debt is 182.5. Now you can plug in the values to the equation and get me beta equity, no? Get me beta equity. Yes, Ashfa, brilliant. Yes. Let's get the answer, guys. Yeah. Get me beta equity. 2.58. Brilliant. Brilliant. Ilma is so fast. Solid, huh? So I plug in the values, people, right? Anyone can do that. Market value of equity 182.5. 182.5 plus, whoa. This is 84. 84 plus 182.5 into 1 minus t. 1 minus t, how much is it? Tax? It's a tax rate. Tax rate is 20%. 0.2. I don't know beta equity, but I know beta assets 0.94. 0.94. So beta equity. Beta equity, yes. Amurti has gotten the answer. Ilma has gotten the answer. People, it's just a simplification, right? Anyone can do this. Beta equity 2.5 something. 2.57. Right? 758, right? Anything is all right. Okay. Done. Done. Now I have beta equity. Now I can get the project specific cost of equity. KE. Same thing. We copy this guys here. Now it's not 2.3, it's 2.57 something. Right? What's the 19.5 done? 0.195. Right, that's 19.5. Guys, what is happening? What's happening? People, right now, the cost of equity is 17.8. What does that mean? For every $100 that you get from your shareholders, they need only 17.8 in return. If you go with this project, they want $19.5 as return. So what does that tell you? That tells you that this project is risky. That's why cost of equity is increasing, right? That's why cost of equity is increasing. No big deal. People, now in the exam, you're not going to show any of this bylaw, right? You're going to do the working. You're going to do the working very fast. No need to say de-gearing, re-gearing, who cares? No need to show any of these betas. Say working number one, removing financial risk. Removing financial risk. And then do the working. Get the de-geared beta. Then working number two, incorporating financial risk. There you go, incorporating financial risk. You have to show the workings, people. The workings should be very, very clear. The examiner is going to look at your working. If your working is right, people, you don't need to worry about the bloody final answer. Even if your final answer is wrong, you get majority of the marks. Are we clear? 6 marks. Very, very simple. Okay, can we do part 2 now? Referring to your calculations above, comment briefly on the view of the commercial director. Our commercial director is telling you, look here, we don't need to have a project specific discounting rate. What a jackass. What a jackass, right? Now you need to tell that commercial director is a jackass, but in a professional manner. How? How? People, type your answers and send it to me. Please don't look at the answer. Don't look at the answer. Don't look at your examiner's answer. What are you going to tell him? So you need to say that commercial director is wrong. Why? Why? A part 1. Yeah. A part 2. What are you going to say, people? What are you going to say? That commercial director is an idiot and he should be fired? No, no. You need to say, if we use the current cost of equity to appraise the new project, then the discounting rate that we are going to use is 17.8. But the correct discounting rate is slightly higher. People, when your discounting rate is higher, what happens to your present value? It falls, no? It falls, right? So if you use, exactly, if you use this discounting rate to discount the cash flows of the project, then you're going to end up with a higher NPV, which is wrong. Which is wrong. That's what you need to say. That's all. You get it. That's it. May not be very good, yes. Yes, yes, you can say that as well. May not reflect the fair value. Yes, yes. Overestimate the value of the project. Very good. That's a very nice way of putting it, right? So I'm gonna say if the current cost of equity is used to evaluate 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 the new project, then a higher NPV will be NPV will be observed due to higher observed higher NPV will be observed. This is inaccurate. 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 The new project is risky. Risky. And this is reflected by the increased cost of equity, right? Cost of equity. Therefore, the project must be evaluated using the project specific key. Right? There you go, people. Are we clear? 2 marks, no? 2 marks, right? You don't need to write a massive answer. 2 marks, yeah? Guys, now always write short sentences, right? See how short my sentences are. No, your examiner likes it when you write simple answers, right? Simple as in, factually correct, but easy to understand, right? Factually correct, no, easy to understand. Anyone can understand. Yes. Are we clear? Okay. Let's look at part B now. Part B is a joke. This is common sense, people. You can answer this, actually without looking at this company's, the whole story. 3 problems Zmo may be facing as a result of what? High level of gearing. People, when you undertake a lot of gearing, what are the problems? What are the problems? Yes, discuss. Huh? You give me some points, any point that is practical. You get marks. Yes, problems of high leverage. Leverage is gearing, yeah. Leverage. What are the problems? Yes. Yes. Someone? Anyone? Yes. What are the problems? High risk of bankruptcy. Very good. Think of our country, right? When you undertake more and more debt, bankruptcy risk definitely increases. Now, don't talk about our country in the bloody paper, right? This is a company, people. You're not to talk about countries in the paper. Huh? You're not to don't show any examples. Use the case study, right? Bankruptcy risk increases. Yes. So what are you going to say under this bankruptcy risk? Ilma, what will you say? May lead to tax exhaustion. Yes. Yes. Very good. That's another disadvantage. Can lead to tax benefit exhaustion. Let me put it like that. Huh? So you're going to exhaust your tax benefits, right? Okay, what else? Yes, what else? What else? People, when a company undertakes more and more debt, think of a company who's going to, let's say, Bank of Ceylon. They undertake a loan, 100 million, right? Then they go to another bank, let's say HNB, right? 200 million. Yes, now HNB is going to increase the interest rate. Yeah, they're not going to lend at the same rate that BOC lent. They'll say, okay, we'll give you 200 million, but pay us 12% interest. You go to another bank. That other bank is going to charge even a higher rate. People, your interest rate is going to increase. When your interest rate increases, then what? Then what? When your interest rate increases, cost of equity also increases. Equity holders are going to demand higher returns from you. Yes. Higher cost of equity. There you go. The more the debt, the more the cost of equity. Does that make sense? Yes. What else? Higher interest payments. Yes. Yes, definitely. Ashwa, can we say problems? Yeah. We can say pressure on cash flows, right? High pressure on cash flows. Cash flows. So, Ashwa, you may have to explain, high interest payments in a bit of a, in a different way. So you can say, when there is so much debt, the company's cash flows are going to go out as interest payments, right? So now there is high pressure on cash flows. Are we clear? Right? What else? What else? Would, yes, definitely, Ilma. So higher cost of equity. Overall, your WACC increases. We can say higher cost of equity. We can say the higher the debt, the higher the cost of debt, and cost of equity, right? And we can say, therefore, higher the WACC. The higher the, therefore, the higher the WACC. What else? See, people, you have so many answers that you can write. Yes. What else? What else? Liquidity problems. Yes. Very good, Ilma. So when we talk about cash flows, you need to address that point. Yeah. So I'll say liquidity issues. Liquidity is cash flows, no? Right? Liquidity. Liquidity. What else? What else, guys? Yeah. We have so many points now. So many points. Yeah. So many points. What else? Guys, can we talk about debt capacity? Debt capacity. What the hell is debt capacity? I think I explained this even the other day, during the first revision class. Debt capacity is the amount of debt the company can undertake. So when you undertake more and more debt, your debt capacity goes down. That's not good. When you undertake debt, yes, automatically your debt capacity reduces, but you have to increase that capacity by making, debt repayments. If you don't make debt repayments like how we did back in, 2019, people, bankruptcy is what you're looking at, right? So I'm going to say higher debt leads to lower debt capacity. Leads to lower debt capacity. Yep. Banks may refuse to provide. Yes. Hemant Kumar, that is what is meant by lower debt capacity. Okay. Right. There you go, people. Come up with a basic, explanation for maybe 3 of these, right? Because you're looking at 6 marks. Guys, if you have a lot of points, right? If you have a lot of points, write all of them, right? You write all of them. Let's say, for 6 marks, guys, I think 3 will be enough. But let's say you want to write 4, then you keep your explanations short. You can write number of points, no harm. But if the markage is like, if the mark allocation is 2, then you don't write 6, huh? If the mark allocation is 2, then maybe 1 or 2 answer points. If it's 6, yeah, maybe 3 with a with a with an explanation. In the exam, guys, it's always better to write number of points with less explanations. Please keep that in mind. Rather than writing one or two answer points with huge explanations, it's always better to write number of points with small explanations. Did you get that? Right? So I'm going to say in the exam, better to better to write better to write number of points with brief explanations. Don't write a lot. Brief. Be very brief. Are we clear? Yes. So they specify 3 points. Oh, wait, do they specify 3 points? Oh, right. Yes, yes, yes. They specify three. No, yeah, I did not see that. Ilma, thanks. Yes. Discuss 3 problems. Yes, then you stick to three. Don't write anymore. Right? Waste of time. Super. But if they don't specify, always remember this. Better to write number of points, but with small explanations. Okay? Right. There's another part, people. What is that? Oh my goodness. People, please read part C and tell me what you're going to write. Hmm? In respect of both equity and debt, discuss the risk return relationship. Okay, people, there are two things that we need to address. In respect of both equity and debt, discuss risk return relationship and how it affects ZMO's financing costs. Okay, people, I surely can talk about risk and return relationship of equity and debt. That is easy. That is it. Easy. So what are we going to say? Should we talk about capital structures? No. Okay, good question. Good question. Should you talk about capital structures, the curves, KE, KD, optimal, leverage point? No, no, no. Please look at the question, Ilma. So you have to write the answer in reference to ZMO's financing cost. Now, the chance of you getting a question where they ask you to talk about capital structures, the curves, and whatnot is extremely low, right? They will not ask you to explain. They know that you know those. They will apply that theory to a question and then they'll ask you to explain. Ilma, here, you don't need to talk about the curves and whatnot. You need to be, very smart here. Discuss the risk return relationship. Guys, what is the relationship between risk and return? What is the relationship between risk and return? Higher the risk, higher the return, no? Right? That is the most basic relationship, no? So I'm gonna say, right, risk return relationship, no? Okay, risk return relationship. The higher the risk, right? The higher the risk, the higher the return. This is like the rule of thumb. Higher the risk, the higher the return. Right? We can clearly see that by undertaking the new project which has a higher risk, a higher cost of capital, is observed. So we can clearly see that by undertaking the new project, which has higher risk, higher cost of capital is, demanded. There you go. So we are proving our point. Yes. So we saw because of the new project, the risk increased. So therefore, cost of capital increased, right? Cost of capital increased. Yeah, cost of equity increased. Can we make this cost of equity? Cost of equity, uh, cost of equity is higher now. Are we clear? Yes, right. Okay. Now people, now maybe say that there is a direct, there is a direct relationship between risks of a project and return demand. Project and return demand. Okay. There you go. This is the risk return relationship. Done. Yes, risk return relationship. Now, people, let's talk about risk return relationship between debt and equity. Risk return relationship between debt and equity. Guys, which is more riskier, debt or equity? Which is more riskier, debt or equity? Equity, very good. Ilma, why is equity more risky? Why is equity, why is it considered high risky? Because it has variable returns. Very good. Very good. Yes. Guys, equity holders are residual claimants of a company, right? Residual claimants. They get their returns after the company meets all its production costs, operational expenditure, interest, taxes, then only they get their cut. Sometimes they don't get anything, right? Even if a company has profits, sometimes shareholders, may not get dividends. The directors will say, look here, we are keeping all our profits. You don't get dividends. Sorry. Can shareholders, demand, higher returns? How can you do that? We need returns. No, you can't do that. You have to keep your mouth shut and wait. Yes. So I'm going to say equity holders carry the highest risk, the highest risk because they are residual, that's what you call them, residual claimants, CLAIMA, claimants of a business. Residual claimants as in, what does that mean, guys? Residual equity holders get their returns only after the firm meets all other expenses. There you go. Right? So because of the higher risk, they demand higher returns. Due to the higher risk, they demand higher returns. What about debt holders? What about debt holders? What can we say about debt holders? Why is their risk lower than that of equity holders? Yes, Ilma, why is their risk lower? Why is their risk lower? Fixed return, very good. Debt holders, in comparison, carries lower risk due to fixed nature in their returns. Therefore, returns demanded are less than that of equity. There you go. So this is why we say KE is greater than KE. KD, sorry. KE greater than KD. Guys, you can clearly see that in this question, yes. KE was 19.5 something. KD It was 7.5 for the redeemable debt, and sorry, 7.5 and 6.5 and 7. 6.5, 6.5 and 7. There you go. So you can clearly see that, right? Are we clear? Are we clear? Yes. So guys, an advantage of getting debt is due to debt, you're going to get tax savings. Yes. Can we say that due to debt, due to healthy debt undertaking, debt undertaking, company or the firm can enjoy tax benefits. Are we clear? So we are just coming up with like points. Yeah, you're coming up with points. People, now here there are two types of debt. You have the irredeemable debt and you have the bank debt. Yes. People, both are secured. Yes, both are secured debt, right? Both are secured debt. What does that mean? If the company is unable to pay the interest may if the company is unable to make the interest payments, then no problem, right? Debt holders are safe. Why is that? Because the debt is secured, right? They will sell the asset that is backing the loan up and get the money. Are we clear? You have to make a note of that as well, right? In this, in ZMO, both debt are secured, both debt are secured. Meaning, if the firm defaults, then debt holders may sell the security and recover the dues. There you go. Are we clear? People, yeah, they will recover their dues. Got it? Yes. Are we clear, people? Up to this? Also, guys, I think we need to talk about, the fact that, another advantage of debt is, right, in the event of bankruptcy, debt holders are given priority, over equity holders. That's something that you need to highlight. In the event of bankruptcy, debt holders, they get their cut, so they don't need to worry about anything, right? I mean, sometimes they might not get all their dues back, but they get something. Are we clear? They get something for sure. What else, people? What else can we say? What else can we say? Any other points? Any other points? Any other points? Yep. What else can we say, people? So they're talking about the financing cost as well. Now, financing cost is basically cost of capital, that is cost of debt and cost of equity, right? Can we make a note of the percentage, right? So your cost of debt, cost of equity, you can see that cost of debt is under 10%, but KE, oh man, their KE is greater than 15%, right? So your KE is higher mainly because you have a lot of debt. Are we clear? You have a lot of debt. That is clearly stated in the question as well. You have a lot of debt. Guys, do you see that these two loans have two different interest rates? Right? So I am thinking they must have issued these irredeemable loans, like firstly, bank loan is the second loan. So the bank is demanding a higher rate now. That's what I'm thinking. Yeah. So bank loan rate is higher. Does that make sense, people? So can we talk about finance risk where increase in debt? Bill, yes, yes, of course, Ilma, yes, 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 yes. You can talk about that as well. No harm, no harm. Yes. So can we say now we have to talk about financing costs? No, that's what I'm thinking, Ilma. Yeah. So you can say, um, you know, uh, cost of equity, right? When uh, uh, when finance costs are concerned, uh, it is clear that due to high level of gearing, equity holders equity holders are demanding a return higher return. Yes. uh, High level of gearing. This could also be the reason why this could also be the reason why bank loan rate is higher than the loan note rate, right? Guys, now you talk about in FM you talk about pecking order theory, right? Yes. Uh, in pecking order theory, yeah. What is the logic on the pecking order theory? Tell me. Now you guys are not very fond of theory. Now let's talk theory. Okay, Ilma, what does pecking order theory tell you? Like in very simple terms, what does it tell you? Pecking order theory. Yeah, waiting. You can unmute and speak. Right? No issue. Pecking order theory. Yes, yes. Very good. The order in which the companies usually fund their projects. Yeah. Now you have different ways of getting finance now, right? You can get finance from outside. You can use your internal, reserves if you have. Yes. Okay. Now tell me, companies, let's talk about the pecking order. Talk about the pecking order. This has nothing to do with, now pecking order is not what you're going to talk about here, but I can take something from pecking order theory. Companies prefer retained earnings now. Firstly, they prefer retained earnings. Yes, yes, very good. Retained earnings. Then debt capital. Definitely debt capital, right? Retained earnings. Okay. Retained earnings. So any company will use their, reserves firstly. That's the logic. They don't have to beg, for money from outside parties if they have money. So they will use their reserves. Then they will go for debt capital. Then only they'll go for equity capital. Yes. Now, in capital structure theory, guys, you talk about signaling effect. Yes. What is signaling effect? Ilma, what is signaling effect? Signaling effect. Do you learn that? Yes, you definitely learn that. Yes, I remember it's there in the syllabus. What is signaling effect? What is the signaling effect of debt? Guys, when you issue debt, there is a signaling effect. So when you raise money, yeah, uh, companies prefer debt capital over equity capital. Why is that? Because debt has signaling effects. People, you check financial statements of any company, Tesla, Microsoft, Coca-Cola, any company. People, these are biggest companies on earth. They have enough and more money, but they still have loans. They still go for loans. Why is that? The reason is signaling. When companies undertake debt, it sends positive signals about the company. What are the positive signals? When a company undertakes debt, the market, the investors are going to think about it in this way. Yeah? This is how they're going to think. Wow, this company, they're undertaking a massive debt, right? They're going to do a project with the borrowed money. Brilliant. So they must be undertaking debt because they have enough money to settle the debt. There you go. That's how people think in the market. That is the signaling effect. Ilma, do you learn signaling effect in your syllabus? Kaif, Ashfa, signaling effect is there, if I'm not mistaken. Yeah, there you go. Yes, it's there. There you go. That is the signaling effect. But you learned it for dividends. We learned it for dividends. Signaling effect of dividends. Guys, there is a theory. Now, in ACCA, you don't talk about a lot of theories now. So at universities, we talk about a lot of theories. Signaling effect is actually a theory, right? You call it signaling effect of debt. If it's not covered in like the ACCA curriculum, dividend relevancy. Yes. That's one of the reasons why dividends become relevant. Yes. Uh, okay. That's okay. So just a small, point, people. When companies issue debt, people like it. People think of it as a positive thing, right? Then what happens is because they're happy, they buy shares of that company. So share price increases. Are we clear? Let's talk about that, right? And then we'll stop. Yeah. When the firm finances its projects using debt capital due to signaling effects, share price may rise. Are we clear? Are we clear? This is enough. This is enough. This is more than enough. Yeah. Don't talk about picking theory and all that. It's not very relevant, people. Are we okay? Yeah. This is enough. We have talked about a hell of a lot of things. A hell of a lot of things. They don't want us to talk about how the company is going to, resolve this problem of high leverage or whatever. Let's not go there. We have, a lot of solid points, right? Guys, now when you write answers in the exam, right, especially when there are like multiple requirements in a question, you can have subheadings. You can have subheadings to talk about this. Okay. Could you please? Yeah, Ilma, you know what? I'm going to share this document on the group, right? I'm going to definitely put this on the group. I'll share this on WhatsApp. Then you can, have a look at it. No big deal. Yes. Right. Okay. Okay. Is there a specific structure to answer the theory questions? Not really. Now, guys, now please look at the question, will you? Your theory questions are narrative questions are like 4 marks, 5 marks, 6 marks. Sometimes it's 9 marks. I've seen 9 mark questions as well. In these questions, you're going to see multiple requirements. Look at this, will you? In respect of both equity and debt, discuss the risk and return relationship. And there you go. See, this is one requirement, and there you go. This is the second requirement. So now what you can do is, right, yes, you have to have a small structure, right? You need to, have a flow in the answer. You can't have things here and there, right? If there isn't a flow, people, then problem, right? So my advice is you read the question very carefully, right? If there are multiple requirements, you tackle the requirements one after the other. So firstly, risk return relationship, and then say risk return relationship between debt and equity. And this is where we talk about the financing cost. This is where we talk about financing cost. Okay, financing cost. Have headings. Don't have like 5 headings in a question, in an answer, but by having a heading, you're essentially making the examiner's life a bit easy. You get it? Your examiners, guys, with marking these answers is a that's a tough job, right? It's a tough job that they're doing. They don't like it. They get paid for it, but they don't like it. Trust me when I say that. Right? They get paid handsomely for marking papers, but they don't like it. It's difficult. Yes. So make their life easy. Always leave lines. See how I'm like, writing my answers, typing my answers rather, short sentences. No need to write, complicated, sentences with all these, bullshit terms. Be very simple. Okay, getting questions. Impress the examiner, yes. Should get the hang through, yes, exactly, yes. Varies based on each requirement, yes, Ilma, yes. Now usually in narrative questions you have multiple requirements. That's the case. You have multiple requirements, so tackle those requirements one after the other. Okay, so that's why I said, Ilma, what you can do is you take, let's say tomorrow you're free, you're at home, right? When you wake up, right? If you don't have any work, right? If you don't have any other commitments, what you can do is you can look at, a few section C questions. I'm not asking you to answer them in full. I'm asking you to look at only part B and C, the theory part. See whether you can tackle it. If you can't, then look at the answer. No harm looking at the answer, people. Get the idea. Now, your examiner comes up with a very complicated looking, answer. Your answers will never be like that. Your answers will be like this only. Simple. Anyone can understand. This is what they want to see. Okay. Please do that. Right? That's the only way you can get the hang of like these theory, parts, guys. Yeah. Are we okay? Right. Uh, do you have any questions, people? Any questions? Any questions? Ashfa, Ilma, Hemant Kumar, Amra, Kaif, do you have any questions? All good, all good. Right. Okay, people, let's go for a short break and then we'll look at LAFO company. Go for a short break for like 10 minutes. Come back in 10 and then we'll look at this. 10 minutes, huh? Right, people, shall we start? Oh my goodness, it's 8:45, no? Guys, shall we look at this? Right? Hello, Ilma. You're very energetic. That's actually really good. We need to have a icebreaker like you in every class, actually, right? Especially in my classes. Okay, let's have a look. Yeah. FM is fun. Yes, yes. I wholeheartedly agree with you. Love this subject. Yeah. Actually, I like FM more than PM, right? You know, FM is my bread and butter, even though I teach PM. Yeah. Okay, people, what are we looking at? A lot of requirements. Yes. The first requirement is rather simple. Yes, you're to calculate TERP, theoretical X rights price, and value of a right per existing share. So you know that this is about what? This is about rights issues. Can we go through the question? Shall we go through the question? Yes. Okay. Please keep in mind the first part is to calculate the TERP and the value of a right per existing share. Okay. Uh, let's read, yeah, the whole thing. Let's read the whole thing. Yeah, go through it, guys. Go through it very fast. No, Ilma, I'm just highlighting, right? PE 11 times, expected to remain unchanged. Yes. Okay. Right. People, uh, pretty basic, you know, case study. You're not looking at anything complicated here. Yeah. Not looking at anything complicated. Yeah. Pretty, straightforward. You're looking at a listed company. They're into ACs. So to generate sales and profit growth. So they want to grow their sales and profits. So what are they going to do? They're going to make an investment. How much? 25.48 million. So massive investment. So they're raising finance, well, in two ways. They're considering two options. Number one, a rights issue. Number two, a bond issue. They're talking about PE ratio as well, right? PE, blah, blah, blah. So they give you the extracts of the latest financial statements, profit from operations, then you have profit after tax. Okay, okay. Tax is 20%. Without new investment, then profit is going to be previous year's profit. Yeah. If investment undertaken, then your profit increase by 4.5. People, can we calculate TERP? Can we calculate TERP? Can you calculate TERP? Theoretical X rights price. Theoretical X rights price is what? Price of a share after the rights issue, no? Yeah, price of a share 2.47. Brilliant. Anyone who calculated theoretical X rights price, TERP? So you need to get the market value of shares before the rights issue, and you need to get the value of the rights issue. Very good, very good. Kaif has also found the answer. So let me do TERP here, guys. TERP, you're looking at share capital 35 million 0.5 per share. So you're looking at 70 million shares now. 70 million, yes. 35 divided by 0.5. What is the original share price? Original share price, current share price 2.6. There you go. People, you're looking at a rights issue of how much? Of how much? People, obviously, you're going to need this much, no? Right? You're going to need this much for the investment, 25.48. So therefore, this is your rights issue proceeds, right? They tell you the current price 2.6 and the discount. So you can get the rights issue. Let's get the rights issue price. Rights issue price, right? Current market price is 2.6, discount is 30%. So this into 0.7, which is 1.82, right? Super. That's my rights issue price. Okay. So if this is the price, people, right? What is the rights issue number of shares? Rights issue shares. People, we need 25.48 million for our investment. One share is 1.82. So therefore, you're looking at 14 million, no? 14 million rights issue shares. Now we can calculate the term. 2.6 plus this is 14 million into discounted price is 1.82 is divided by you're looking at 70 million plus 14 million. Yes, there you go. This is my term, theoretical X rights price. TERP is 2.47. Is everyone clear with TERP? TERP is pretty basic, right? Then they want you to calculate the value of a right. Value of a right per existing share. Existing share. People, so value of a right per existing share, that is TERP minus. So from TERP, you need to minus the rights issue price 1.82 and divide it by number of shares to obtain a right. No? Yes. People, so what is the ratio here? Right? Rights issue ratio. It's 14 million to 70 million. No? So what is the ratio? 1:5, yeah. 1:5. 1:5 is the ratio. Does that make sense? So for every 5, you get 1. To get 1 new share, you have to have 5 shares, people. So therefore, you divide this by 5. Yeah, 504. Yes, 1:5.13 is your value of a right. Value of a right per existing share. Very good. That is 0.13. Is everyone okay with these calculations? Pretty basic, you just plug in the values to the equation. Can't be that difficult. Kai, Fashfa, Amra, all okay. And Hema. Okay. Part A done. Part A done. Right, super. All clear. Now, can we do part B? Part B, what do they tell me? If the investment goes ahead, assuming new investment goes ahead, calculate forecast earnings per share for the coming year, right? And the resulting share price. Okay, they want me to calculate EPS, earnings per share, and resulting share price if it finances the investment using each of the alternatives. Okay. So now we are going ahead with the investment. How? Number one, using rights issue. If you use rights issue, then what is your EPS in the coming year and what is your share price? Number two, loan notes is what you use to finance the investment. If that is the case, EPS and share price, right? That's what you need to do, no? So people, we can say calculating EPS and share price. Calculating EPS and share price. Okay. Number one, using you can say funding through rights issue. People, so you have to find EPS now. EPS, right? What is EPS? Earnings after tax. EPS is earnings after tax divided by total number of shares now. Total number of shares, yeah. So we have to get total number of shares. We have to get earnings after tax. People, do you see that I already know the total number of shares? Total number of shares I know from before. Total number of shares are, there you go, 84 million. Does that make sense? Original shares are 70. Rights issue shares 14. There you go. We know the number of shares. That's my denominator. So what I need to find is my numerator. So I'll say working number 2, earnings after tax. People, can you get me the earnings after tax? I'll give you 2 minutes. Please read this part, right? Read this part and get me the answer. Okay, Wilma got the answer. 20,160. Okay, very good. Kaif, what about you? Ashfa? Do you need more time? Maybe another couple of minutes. Uh, Ilma, if you're done, try part B. So, sorry. Now you find the EPS and then get the share price. Get the share price. Right, go ahead, do it. Use the PE. Use the PE. Now let me make it easy for you, guys. PE ratio. How do I calculate PE ratio? Price earnings per share divided by P, price to earnings. Oh gosh, it's the other way around. Market price per share divided by earnings per share. This is how you find the PE. You know the PE. PE is 11. They tell me that PE is 11 times and it is expected to remain unchanged whichever financing option is chosen. PE 11 people. You know PE, right? So using earnings that you do using earnings per share calculation that you do in working two, you can get market price. Yeah. Others, what's happening? People, so let's get the values, right? No big deal. You have to find the earnings now. Earnings after tax, right? People, earnings after tax has to be calculated using the information that is given. People, they tell you profit from operations how much? 25.5. But if you undertake the investment, forecast profit from operations increase by 4.5. So therefore 25.5 plus 4.5 is what you need to show as profit from operations. So I'll say profit from operations, right? So that's 25.5 plus 4.5, 30. Yes. People, do you see that profit from operations is 25.5, and then you have interest as well, no? You have interest as well. Why do I say that there is interest? Because from profit from operations, when you look at profit after tax, there is a reduction. That means there is what? Interest. There is inbuilt interest here, people. You have to understand that. Yes, there is interest. So what is that interest amount? Interest amount. So you can say interest. You can do a small working. So 25.5 is operating profit. Then you have profit after tax, that is 16.56. There you go. That must be your interest. So you need to deduct that as well. 25.5 minus 16.56. Interest is the same, people. Yeah, interest is the same. So what's my profit? Profit before tax. Profit before tax. Oh gosh, what just happened? 8.94. Profit before tax, guys. Right? So I'll say minus 8.94. Profit before tax is 21.06. Yes. Now you minus tax. Tax is 21%, 20%. 20%. Tax 20%. This into 4.212. So this is my earnings after tax. 16.85. Guys, do you get this? Ilma, your earnings should be 16.85, no? Does that make sense? Kaif, are we clear? Ashfa, all good? So I took 4,500 minus tax on that. Wait, hold on, hold on. Oh gosh. Oh my goodness, you have profit after tax. Oh, yes, yes, yes. Okay, my bad, my bad, my bad. People, they have calculated profit after tax, no? Oh my goodness. We have to do a separate working. Yes, yes, yes. My bad. Shall we say profit after tax? Profit after tax is okay. No, no, my working is wrong. Wait. Profit after tax is 16.56. 16.56. So guys, now I can calculate profit before tax now. Profit before tax is, right, through a mathematical equation, I can say profit before tax is equal to profit after tax plus the tax. Like profit before tax is profit after tax plus tax. Yes, I know tax is how much? Tax is 20%. No? Tax is 20%, right? So I can divide 16.56 by 0.8 to get the profit before tax. No? 20.7 is profit before tax 20.7. Yeah. Wait, hold on, guys. Hold on. Did I make a mistake again? Profit after tax is this. So x minus x into, yeah, x minus x into 20%, that is 16.56. So this is 0.8x equals 16.56. So therefore, x is 16.56 divided by 0.8. Yeah. People, guys, did you get this profit before tax of 20.7? Profit before tax is 20.7. Does that make sense? People, is this how you calculated it? Yeah, very good, very good. So what did I just do here? Ilma, Ashfa, Amra, are we okay? Hemant Kumar. So Guys, I'm taking X as my what? Profit before tax. I'm taking, so this is my profit after tax now. This is my profit after tax. So I'm taking X as my profit before tax. Yeah. So mathematical equation, that's all. X is my profit before tax. Profit before tax, right? So on profit before tax only you charge 20%, right? So when you minus 20%, you get 16.56. So you simplify 0.8. There you go. This is my profit before tax. X is my profit before tax. Are we clear? Okay, now I know the profit before tax. Profit before tax is 20.7, right? You have profit from operations as well. From operations, 25.5. No? So the difference between these two should be my interest payment. Interest payment is minus this. 4,800 is your interest payment. 16.56. No? Yeah. So there you go, people. Interest payment is 4.8. Ilma, is this what you got? Interest 4.8. So you need to minus 4.8. Is this what you got as interest payment? So profit before tax is 25.2. You pay taxes 5.04. Earnings after tax is 20.16. 20.16. Yeah, 20,000. 20,160. People, are we clear on this working? Is everyone clear on this working? Now I can get the earnings per share, right? I can get my EPS. So you can say EPS is, what is EPS? EPS is, there you go. Let me copy this. No, Ilma, I can't hear you now.
Sir.
No, I can't. Did you say something? I can't hear you. Maybe this thing is muted. I don't know. You can unmute and speak. Should be able to.
Can you hear me?
Yeah, now I can hear you. Yes, Ilma, go on.
So they said that the profit from operations had increased by 4,500. So I took 4,500 into 20%, and then I minused. So that was 900. So I did 4,500 minus 900, and that I added it to the earnings after tax which they had already given. Is that fine as well?
Come again.
So
What did
the
you?
increase of 4,500 in operating profit.
Yes, it's increasing by 4.5. No, okay.
Yeah, I minus 20% on that.
Okay.
And then the net impact, I added it to 16,560. 16.56.
Oh, yeah, that is also possible. Yes. You end up with the same answer. Yes,
Yeah.
yes, you can do that as well. That's a very
Okay, sir.
smart way of getting the answer. Solid, huh? That's actually easy. Yes, I did not, think of that. That's brilliant. Solid, huh? Brilliant, guys. Now, what Ilma has done is, so your profits are increasing by 4.5 now. So you calculate the tax on this 20%. And then you get the, profit after tax. So 4.5 into 0.8, you add that to 16.56. Yeah, that's brilliant. That's so time saving. Brilliant, huh? Super. So, let's do that in the next scenario. Brilliant. Earnings after tax is this 20.16. You divide this by number of shares 84. So EPS is going to be, EPS is 0.24. 0.24. Yeah. Okay, so now I can find the market price per share, right? So market price, I don't know, but I know the EPS. EPS is 0.24. 0.24. So now you can get the market price. Market price is how much? 0.24 into 11, 2.64. There you go. This is the market price of a share with the rights issue. With the rights issue. Are we clear? Anyone who's having doubts? Now, this is actually a long way of getting the answer, Ilma. I like your method, right? You getting the net impact and adding that to the this thing is, it makes more sense, definitely. But I don't, does that method work for the second one? Because now you have more loans coming into the picture, no? It still works. Okay, let's see. Right. People, are we okay with part B? Are we okay with part B? Everyone okay with part B? Part B, this is funding through rights, no? Funding through rights. All good, right. Now let's do the second part, funding through loan notes. Funding through loan notes. Now what's going to happen? Funding through loan notes. Funding through the loan issue. People, what's going to happen? Now we are going to have more interest, no? You're going to have more interest, yes? You're going to have to pay a higher interest. You know what, Ilma? So because I use this method, I will stick to this, same method, right? To get the answer, right? So profit from operations 30, interest is 4.8, but now your interest is going to be a bit high. Why? Because you have a new loan coming in. No? So I'm going to say interest 4.8 plus 25.48 million into what is the loan interest rate here? Loan interest rate is 6%. 6%. You pay 6%. Right? 0.06. So how much is this? 4.8 plus 25.48 into 0.06. 6.329. There you go. So tax is 7.26 something. And then you get the earnings after tax 29.06. You're going with the other method. Okay. Profit before taxes. Right. Okay. Yes, Ilma, you just deduct the interest charge. That's it. You deduct the interest charge and then you calculate the tax on that. And you add it to the net. You add it to 16.56. No? Ingenious, ingenious, man. I like the way you think. Ilma, solid. Brilliant, huh? Super. Right. People, are we clear on this? Earnings after tax, this is 29.06. So now I can get the EPS. Let's get the EPS. People, now earnings after tax 29.06. My shares remain at 70 because I'm not going for my rights issue. No, I'm not going for my rights issue. What? Not going for my rights issue. Yes. People, is this your earnings per share? 0.415 something. Earnings after tax. Yeah. Shouldn't you subtract interest? Oh my goodness, yes, yes, yes. Wait, hold on. I have not subtracted interest. 18.94. 0.271. Yes, yes, yes. I have added the interest, yes. And you need to deduct the tax as well, yes. 0.271 is your EPS. Let's get the market price. Right? I'll copy this same thing. P ratio is 11 no matter what option you undertake. So this is 0.271. So therefore, 11 into 0.271 is your answer. 2.981. This is your answer. This is your market price under the debt issue, right? Let's highlight this in a different color. Market price under the debt issue. Here you have 0.264 market price, and this is my EPS. Right. Done. Done. Are they asking me to discuss the ways in which a company can issue? Oh, okay. It's just the calculation that they want me to do. No, right. Part C. Discuss the ways in which company can issue new equity shares. People, how can a company issue new equity shares? Yes, what are the methods? What are the methods of raising money through new equity shares? Yes. Part C. New equity shares. Yes. Discuss the ways in which a company can issue new equity shares. People, you know that you have different methods of issuing new shares now, right? You can go for a public issue, right? That is when you issue, yes, public issue, very good, yes, public issue of stocks. That is when you issue stocks to the entire market. Public issue of stocks. Yes. Then what else? Issue to family and friends. Okay, okay. Now this is Ilma, we are looking at a listed company, no? Issue to family and friends. Yes, definitely that's a method, but let's stick to the boundaries of the question. Let's not talk about family and friends. Huh? Yeah, let's not talk about family and friends. What are the other methods? Guys, now you talk about methods of IPOs, yes? There you talk about private placing or placing shares with certain institutions. Yeah. So in private placing, that's what you call it, private placing. I want you to read these. Yeah. So now this is a method of issuing shares. You place the shares with a few investors. You don't go to the market and issue shares. No, no. You do selective marketing. You identify a few companies or a few, I don't know, banks, big you're looking at big investors. You approach them and you tell them, look here, we want to sell our shares to your company. That's private placement. What else, people? What else? Yeah, what else? Enterprise investment schemes. When you say enterprise investment schemes, what does that, what do you mean, Private placement. Enterprise investment schemes. Walk me through it. Enterprise investment schemes. It sounds like you're talking about private placing. Enterprise investment. Yeah. Offer for sale, offer for subscription. What are the other methods of issuing new shares? Enterprise investment schemes. Anyone? Ah, right. Okay, okay. Ilma, just look up in enterprise investment schemes. Enterprise investment schemes are more suited for unquoted companies. Unquoted companies are not quoted. Rights issue, yes. Now rights issues, ask for rights issues. You don't go. Yeah. You're issuing new shares. No, yes, definitely. Why didn't I think of that? Yes. Definitely rights issues. Yes, because you're issuing shares, new shares. Very good. Bonus issue. Bonus. Okay. Kaif, in a bonus issue, you issue shares free of charge, right? Yes, that's what. Kaif, bonus issues usually happen free of charge. So is public offer the same as public? Yes. Public offer or public issue of stock. So public offer, same thing, right? Yes. Okay. What else, guys? What else? Well, yes, script dividends. Now, okay, guys, these are, script dividend is basically a method of instead of shares, you provide, instead of cash, you give your shareholders shares. That's not a method of issuing shares. Please understand that. That's a method of distributing dividends. Ilma, are we clear? Right? We are now, please stick to the question. They want us to talk about ways in which a company can issue new equity. IPO, can't we talk about IPOs? Initial public offerings. That's a way of issuing shares. Kaif bonus free of charge. Huh? People, this is enough. This is enough. Yeah. Uh, Public offers. Yeah. Now we can make a small change here. Can be public offers is actually IPO is when you go to the market for the very first time. No. When you say public offers, you're referring to like secondary issues of stocks. But you're looking at the same thing more or less now. IPOs and secondary issues. You know what? We'll put it like that. Yeah, makes sense, Ilma. IPOs and IPOs and public offer of stocks, like secondary issues. Secondary issues. Yeah. What else, people? Private placing, rights issues. Yeah, these are the methods, no? These are the methods. That's what the ways in which a company can issue. Guys, what about offer for sale, offer for subscription? Offer for subscription, that's another method, no? you request investors to subscribe for your shares, offer for subscription. Yes. Actually, there are, these are the methods. You have about, 3-4 points, yeah, that you can talk about. You can definitely, you can write like a, brief explanation on each of these. Okay, this is enough. Yeah, this is enough. Okay, there are methods. Okay, script dividends, bonus issues. No, please understand that yes, they involve issuing shares, but the primary purpose of issuing shares is to raise money. When you go for a bonus issue, you don't raise money. When you go for a script dividend, you're not raising money. Yes. Do we define each one? Yes. Like give a brief explanation. No. Now, for example, you can say IP when a company goes public for the very first time, it is called an IPO, right? Also, companies who are already listed, they can go for secondary issues of shares. Something like that, Tilma. Private placing, you can say companies directly approaching a few large investors and selling shares directly. Oh, there you go, like a small explanation. Yes, small explanation is enough. Okay. Kaif, Ashfa, are we okay? Are we okay? Right. Now, let's look at this. Good, good. Okay. Shall we look at part D? Discuss and recommend whether LAFO should raise finance it requires by reducing its annual dividend. People, can you read this? Can you read this and come up with a few points? Now, you need to recommend, discuss and recommend. Yeah, what can we say, people? They can reduce because earnings retention would increase, which may increase share, but decrease in dividends would give a negative signaling. Yes, yes. Okay. Okay, let's see. Okay. Ilma, brilliant. Came up with an idea. Yes, definitely acceptable. Let's have a look. At a recent board meeting, to discuss financing options, director suggested reducing the forthcoming dividend. Right. People, they have an investment to make. They want 25 million. That's a buttload of money, right? So now they are talking. One of the directors suggested, we should reduce the dividend. When you reduce the dividend, yes, you can, you know, you don't now, when you reduce the dividend, guys, let's say your dividend is 5 million. So you don't pay that 5 million. So you can use that in order to finance investment. So you will have to borrow, something less than 25. Makes sense. In the past few years, LAFO has consistently paid an annual dividend of 0.08 per share. People, this company, consistent dividends. Consistent dividends. Consistent dividends, how much? 0.08. People, out of nowhere, if they, all of a sudden cut down their dividends, that's going to become a bit of a problem. Shareholders are going to get worried for sure, right? So right off the start, I can say, cutting dividends entirely is not very good. It's not very lucrative, right? Constant dividends, they have paid dividends in the last whatever years. So you cutting down the dividend, not that great. Yes, not a good idea. People, now, okay, so let's say they cut down the dividend, right? They have paid how much? 0.08 per share. Let's say, assuming dividends are not paid, how much are they going to save? Cash that is saved. Dividend per share is 0.08. How many shares do we have? We have about how many shares? 70 million. Yes. So how much money are you saving? 0.07 into 70. You save about 4.9 mil, right? What is your investment cost? Investment cost is 25.48. Sorry, what? 20, yes, 25.48. So balance that needs to be funded, balance that needs to be raised. So you don't pay the dividend, so you still need about 20.58. No, that's peanuts compared to what you save. No, right? You save only 5 million. That's peanuts compared to your investment cost. Can I say saving as a percentage of investment? So 4.9 divided by 25.48. Even this is of you save about 20%, not even 2019. So 20, let's say 20. People, you still have to raise 80%. Why do this? This is, I don't think this is a good idea. No, no, definitely no. You talk about dividend relevancy theory, right? So, when you cut down dividends, all of a sudden, the investors are going to get worried. That, you talk about clientele, clientele argument in dividends. Yeah, there are certain investors who rely on the dividend, right? Ilma, you talk about clientele theory. Yes, clientele. Do you talk about the clientele theory? Clientele. Yes. So you have certain investors are loyal. Yes. Clientele theory, do you talk about this theory called clientele? I can't remember because I have not clientele. No? Oh, okay, okay. You know what? Forget it. Guys, now, I'm sure you know this. Now, you know, there are investors who rely on dividends, right? So, investors in the market become loyal to certain groups of companies, right? Let's say, Ilma, you like dividend paying companies. You don't want, you don't want a company, that is not paying dividends. You want your company to pay dividends. You're an investor like that, right? There are lots of investors like you in the market, loyal investors, loyal short term. Yes, yes. So they want short term returns. Yes. So if you have to say if dividend is reduced, which is only 19% of the total investment, the firm still needs to fund need to fund 80%, 80%, right? Uh, since the firm has paid dividends consistently, cutting down dividends entirely, all of a sudden may lead to investor dissatisfaction, right? Especially if there are investors who rely on dividends, they may leave the firm altogether. Are we clear? Guys, now in finance, there's this theory called clientele theory. In clientele theory, we say that, you know, investors in the market can be grouped. Some investors like dividend paying companies. Some investors don't like dividend paying companies. Now think of Warren Buffett. Warren Buffett is a person who doesn't like dividends. He wants returns into the long term. Yes. People now, a simple example, that BYD, Build Your Dream, BYD is becoming very, very popular in Sri Lanka. Yes. Do you know that Warren Buffett has purchased 10% of that company in 2003? Yes, Warren Buffett has purchased 10% of that company. That's close to 230 million something people, right? 2003, yeah. Now only BYD is, generating returns. There you go. There are investors like Warren Buffett who will wait, right? Wait for years to get the return. Some investors aren't like that. They want returns in the short term. So if there are investors like that in this company, they are going to get so dissatisfied and they're going to sell the shares and leave the company altogether. Are we clear, people? Yes? So people, now I'm saying don't cut down the dividend. Don't cut it down entirely, right? Problem. So what can they do? The firm needs to consider ideally debt capital to fund the project. Yes. Why debt capital? Why debt capital? Tax savings and also signaling effect. What I just explained. Don't go for equity issues. You can clearly see when you go with debt, guys, your EPS is 0.27, your market price is 2.98 compared to 0.24 EPS with rights issue and 2.64 market price. Do you see that when you go with debt, when debt capital is used to fund the project, to fund the project. Then EPS as well as the share price increases compared to funding the project via the rights issue. There you go. These are the points that you need to write. Are we clear? Are we clear? When you're free, please, Google clientele theory. Clientele. Yes. Guys, are we clear? Are we clear? Ilma, any questions? Any questions? Did you understand my explanations? All okay? Kaif? Okay, good, brilliant. Okay, so people, we have looked at two solid questions on long-term financing, right? Be very practical when you come up with answers. The only way to study theory is by looking at questions, not by looking at the note, right? The note is not going to help you at all, people. Trust me when I say that. Okay. Can we recommend? It depends on the proportion of shareholders, financial institutions, and individuals. If majority, they can cut on dividends in their long term. Of course, yes, Ilma, you can argue that yes, if the company is funded by institutional investors, right? That's a good point. If the company is funded, or if the company's investors are majorly institutional investors, right? If if they are institutional investors, okay, if they are institutional investors such as pension funds and mutual funds, actually, Ilma, institutional investors, now if you are to talk about institutional investors and compare them with individual, yes. If companies investors are majorly institutional investors, yes, then they they will not be dissatisfied. They will not be dissatisfied even if there is a dividend cut. Yes, definitely. If the company's investors are majorly institutional investors, like big investors such as banks, mutual funds and whatnot, they will not be dissatisfied even if there's a dividend cut, because yes, they are looking for long-term growth. But if the company's investors are majorly retail investors, cutting down dividends is problematic. Cutting down dividends may lead to share price fluctuations. Yes, definitely. Also, yes, when you undertake debt, your gearing is going to increase. Gearing increases. As a result, KE may also increase. Yes. Ilma, solid point. Solid point. Where do they say that? Shareholders are made up of. Yeah. Its shareholders include both financial institutions and individuals. No, right. Okay. Yeah, so I think it's better to talk both. Right? you have both, but if majority are institutional investors, then dividend cut will be all right. But if it's majorly retail investors, then problem. Okay, better to talk both. Yes, dividend, of course, yes, you can connect this to dividend policy, yes, but stay within the boundaries of the question. Better to relate whatever to the scenario. Don't just talk theory, right? Don't just talk about theory. Try to relate it to the case study as much as possible. Okay, right, brilliant, solid, Dilma. Solid input, huh? Brilliant. Connecting relevant points, yeah, yeah, that's okay. That's okay. You can, but always look at the mark allocation, right? And there are certain things that are very apparent. Those you'll have to address for sure. And then if there are theories, yes, plug them in, right? Plug them in, definitely. Okay, right. Okay, people. Right. Don't want to drag the class any longer. We have done today's class, nearly for 3 hours. Thank you so much for staying until the very end. Hope you learned something out of this session, people. Next week, we'll look at another area and definitely do 2 questions just like today. Okay. Hope you found this effective. Brilliant. Thank you for joining, guys. Thank you so much. Okay. Thank you. No problem. Right. Thank you. Thank you, guys. Thank you. Thank you. Good night, everyone. Good night, everyone. Thank you.